If your portfolio looks like a roller coaster, you're not alone. But don't worry, we're here to help. The stock market is a roller coaster of booms and busts. And if 2025 brings a downturn, the question isn't will it happen, but are you ready for it? Welcome to Capitix. Today, we'll show you how to navigate a market crash without fear, turn volatility into opportunity, and position yourself for long-term gains. Smart investing and long-term wealth building are our game. Let's get started.
Welcome to the channel, where we break down finance, investing, and personal growth in a way that actually makes sense. If you're serious about building wealth, you're in the right place. Now, I know what you're thinking. Another market crash prediction. Seriously, trust me, I get it. But here's the thing, the market crash again. It's not a matter of but, and when it does, you need to be prepared. That's what we're talking about today. We're not going to try to time the market, but to potentially thrive in the aftermath. But we are going to equip you with the knowledge and strategies to not just survive a crash. So buckle up, hit that subscribe button, and let's dive in. Look, I've been investing in small cap funds for years, not just in the last couple of years when small caps started booming. I've seen firsthand how small businesses can grow exponentially over a 5 to 10 year period, and I truly believe in the potential of well-managed small cap funds, especially in a volatile market. Here's why. Small cap companies are often nimble and adaptable. They can pivot quickly to changing market conditions and capitalize on new opportunities faster than their larger counterparts. Think about it. A massive corporation like, say, Coca-Cola is like a giant ship. It takes a lot to turn it around, right? But a small, innovative tech startup, they can change direction on a dime. This agility can be a huge advantage during a market downturn. While the big guys are struggling to adjust, small caps can be finding new markets, innovating, and coming out ahead. Now, I'm not saying small caps are immune to crashes. They're not. But historically, they've shown the potential to rebound faster and stronger than large cap stocks after a downturn. And that's powerful. Of course, not all small cap funds are created equal. You need to do your research, look for funds with strong management teams, solid track records, and diversified holdings. Don't just jump into the first one you see. Remember, investing is a marathon, not a sprint. And just like a marathon runner needs the right fuel and training, your portfolio needs the right mix of investments to weather any storm. Small cap growth funds can be a valuable part of that mix. Now, if you're looking for a single fund that offers a bit more flexibility and diversification, let me introduce you to my personal favorite, the Fidelity Multi-Cap Growth Fund, FMAGX. This bad boy has been a cornerstone of my portfolio for years, and for good reason. First off, FMAGX has a proven track record. I mean, this thing has consistently delivered solid returns over the years, even during periods of market volatility. That kind of consistency is crucial, especially when the market feels like a roller coaster. But what I really love about FMAGX is its diversified approach. See, it invests across a range of market capitalizations, meaning it holds a mix of small, mid, and large cap stocks. This go-anywhere strategy gives the fund managers the flexibility to adapt to changing market conditions and potentially capitalize on opportunities wherever they arise. And let's talk about Fidelity for a second. They're not some fly-by-night operation. Fidelity is a powerhouse in the investment world, known for their rigorous research, experienced portfolio managers, and commitment to transparency. When I invest in a Fidelity fund, I know my money is in good hands. Now, I'm not saying FMAGX is a guaranteed home run. No investment is. But with its strong track record, diversified approach, and the backing of a reputable firm like Fidelity, it's a fund that I believe can weather a market storm and come out stronger on the other side. And that's what we're looking for, right? Investments that can help us not just survive, but thrive, even when the market throws us a curveball. Now, no matter what your investment strategy is, no matter what your risk tolerance is, there's one thing I recommend everyone have in their portfolio: a good old-fashioned S&P 500 index fund. This is like the bedrock of your investment strategy, the anchor that keeps your portfolio steady even when the seas get rough. Think of it like this. The S&P 500 is like owning a tiny slice of the 500 largest companies in the US economy. You've got Apple, Microsoft, Amazon, Google, all the heavy hitters. And when you invest in an S&P 500 index fund, you're essentially betting on the long-term growth of the American economy. And historically speaking, that's been a pretty good bet. Now, I personally invest in the Vanguard S&P 500 ETF, also known as VEO. Why? Because Vanguard is known for their low fees, which means more of your money is working for you. And VEO gives me broad exposure to the entire S&P 500, so I'm not betting on any one company or sector. But here's the key. Index funds are designed for the long haul. They're not about getting rich quick. They're about slow, steady, consistent growth over time. And that's why they're so powerful during a market crash. See, when the market is in freefall, it's easy to panic and sell everything. But if you've got a solid chunk of your portfolio in a low-cost S&P 500 index fund, you can ride out the storm knowing that, historically, the market has always recovered. Remember, investing is a marathon, not a sprint. And an S&P 500 index fund is like your reliable running shoes. It might not be the flashiest part of your gear, but it'll get you to the finish line. Now, for those of you who are a little more comfortable with risk, who are looking for investments with the potential for outsized returns, let's talk about technology and innovation ETFs. See, the US economy is being reshaped by technology at an unprecedented pace. And I believe that trend is only going to accelerate in the coming years. Think about it. Artificial intelligence, robotics, biotechnology, these aren't just buzzwords. They're industries that are poised to fundamentally change the way we live, work, and interact with the world. And investing in the companies at the forefront of these innovations could be incredibly lucrative. Now, I personally hold the ARK Innovation ETF, also known as RKA. This ETF is known for its focus on disruptive technologies and its holdings in companies like Tesla, Nvidia, and Square. These are companies that are pushing the boundaries of what's possible, and RKK gives me a way to invest in their growth potential. But here's the thing, ARK is not for the faint of heart. This is a high-risk, high-reward investment. It can be volatile, and it's not uncommon to see swings of 5% or more in a single day. So why do I invest in it? Because I believe in the long-term potential of these disruptive technologies. I believe that companies like Tesla and Nvidia are going to be the leaders of the future, and I want to be along for the ride. Now, I'm not saying you should go out and dump your entire life savings into RKK. This is an investment that requires careful consideration and a strong stomach for volatility. But if you're looking for a way to potentially supercharge your portfolio's growth and you're comfortable with the risks involved, technology and innovation ETFs like RKK could be worth exploring. So, there you have it. 4 investment strategies to help you not just survive a market crash, but potentially thrive in the aftermath. Remember, the key is to be prepared, stay calm, and stick to your long-term plan. If you found this video helpful, hit the like button, subscribe to the channel, and drop a comment letting me know how you approach investing. Stay smart, stay invested, and I'll see you in the next one.